A very good morning and welcome to Grant Thornton's latest webinar. So today we're going to be talking about tax governance, risk management, and also some very important changes to the VAT law as well. Next slide. So today's speakers, we are joined by Anush, who has over 20 years experience in tax, Imran, who's our latest VAT partner in indirect taxes, again, over 20 years experience. Isabel, CT Director based in Abu Dhabi with over 17 years experience. And lastly, Anna, who works in transfer pricing as a director based in Dubai, again with 17 years experience. And myself, Stephen Kitching, I'm head of tax here at Grant Thornton based in Dubai. I have over 20 years experience. So collectively, across the panel, we have over 90 years experience. So we're well represented today in terms of tax knowledge. So in terms of the agenda, this is what we're going to go through today. The webinar is recorded. So for those that are joining now, it is recorded from the start and you can play that back at your leisure. It'll also be posted on LinkedIn as well, so you can watch that repeatedly if you'd like to. But in terms of what we're going to cover today, these are the main points on the agenda. So importantly, we are going to talk about governance, and the obvious reason for that is that in terms of any governance here under a tax regime, it's important to be compliant with the regulations and the laws, obviously to avoid financial penalties which do arise. So we will go through corporation tax first with Anush, transfer pricing with Anna, and then latterly Imran will cover off in terms of indirect taxes and also the latest changes to it as well. In terms of questions, if you do have any questions, then please do post them. There's a Q&A box at the top of the meeting invite. So post the questions in there and we'll try and address some as we go along through the presentation. And then there is a session right at the end as well, where we'll pick up some of the questions that you've asked. So please do fire them in there and we'll try and answer as many as we can. If we don't cover them today, then we will get back to you. So obviously put your name against your question so we can contact you and give you a reply back to it as well. So without further ado, I'll hand over to Anush to take it forward from here. Thank you.
Thank you, Steve. Good morning, everybody, and a warm welcome. I think since we are here to discuss about the significance of a well-governed tax infrastructure and how an inbuilt tax infrastructure can really help you maneuver through various tax uncertainties, which within the region and specifically within UAE, we all keep on encountering. At first, it's equally important to really understand and appreciate our tax surroundings. It is important to understand and realize how UAE has transitioned and transformed itself from virtually a zero tax economy to first being a consumption tax related economy wherein excise tax and customs tax were introduced and levied on certain specific trades and consumption patterns. We thereafter saw how a transaction-based VAT regime was implemented, which is now 7 years old, or should I say 7 years new, as it continues to evolve and reshape itself with new business models, new commerce and new trade-related patterns which the country is experiencing. Then UAE committed to certain international tax principles such as economic substance regulations, country-by-country reporting. To us as tax professionals, this was a robust data gathering and data transparency, tax transparency standards which UAE committed to and successfully implemented. And ultimately, we saw the most anticipated corporate tax and transfer pricing regime being implemented with various international tax principles imbibed from various parts of the world. And this directly impacts the bottom line of almost all businesses run within the country. Of course, if we gauge into the future, into the near future, we are yet to see how Pillar 2 or the global minimum tax would take form and shape within the UAE corporate tax regime. And in due course, we will see how the federal tax authorities conduct corporate tax and transfer pricing audits. One could also argue that a robust withholding tax regime, or maybe some sort of an advanced tax regime, which we are used to seeing in the farther Middle East region, could well be part of the UAE tax regime as we speak. But for now, for all practical purposes, these laws form the pie of UAE as a federal. And these are the laws which continues to make us challenge us from a business model perspective, from a tax positioning perspective, and we need to maneuver through these challenges. Now, whether you are a trader, whether you are a fintech player, whether you are somebody with an industrial license, whether you are an MNC with UAE outfits, whether you are a family-owned business, it is fair to assume that most of the provisions of these several laws would impact you either operatingly on your profits, on your transactions, or from a documentation perspective. And hence the need for a well-governed tax infrastructure, a tax governance framework which can empower you to maneuver through these challenges and ultimately add shareholder value while a tax levy is charged on your net profits or on your transaction basis. Moving to the next slide. So what really are the key principles of a tax governance framework? I think if I was to start and give certain examples, just like from an accounting perspective, we are used to seeing accounting policies which are predominantly driven by either IFRS or US GAAPs, or a HR policy driven by certain mandates given to the HR team within an organization. There ought to be a clear strategy and a tax policy which helps the stakeholders understand transparently as to what really are the tax risks a particular business model or a structure is exposed to. In what manner does an organization go about adopting technical positions on critical tax matters? At what level does a particular tax matter get escalated or a particular tax responsibility gets delegated, depending upon the impact of it on the bottom line? What level of stakeholder management and communication is maintained within the organization to ensure, for example, if you are a business which is looking at a possible IPO or a business which is looking at a particular strategic fundraise, how is it that your tax exposures, your tax risks are not only documented properly, but also accurately implemented or appropriately communicated to the stakeholders? This would be relevant to ensure that the tax profile is well set and neither is over nor underestimated. Starting from your first fiscal year, you would be required to make certain tax provisions. You would be required to account for uncertain tax positions, and some of us may even have an impact on the balance sheet via a deferred tax provisioning. All these and many other reasons lead to having a robust tax efficiency management, but at the same time ensuring that whether it is the legal boundaries of the law or the ethical boundaries of a tax profession, these are well respected while we all thrive to optimize our effective tax rate. Having said that, and talking about stakeholders, the Federal Tax Authority or any other authorities within the UAE would continue to be part of being a stakeholder in terms of communication. So is there a process through which transparency can be developed with the tax authorities? And we would see as we cover various elements during this presentation, whether it is private clarifications, whether it is advanced pricing mechanisms, whether it is reaching out for a particular tax provisioning matter, the participation and the transparent relationship with the regulators will continue to form an important element of how efficiently your ETR, effective tax rate, is managed locally. Also, whether you have an internal tax function which continuously is exposed to the evolving nature of the tax laws, do they require periodic trainings to upskill, or is it a better alternative to outsource to a capable tax consultant? What is the process adopted to even identify what's good versus good for you in terms of insourcing or outsourcing? And several other challenges should form part as the principles or the fundamentals of governing a well efficiently run tax function. Ultimately, the role of technology can never be underemphasized. And as we speak, various technological tools are being made available out there in the market. Either they are specific to a particular sector from an accounting and a tax perspective, or certain ERP solutions have already been implemented in order to efficiently run the finance function. But it's about time that tax sits in the boardroom and is driven as an important parameter of decision making upfront. And technology is leveraged not just to ensure that the compliances are in check, but at the same time, Review and analysis and technical analysis of the tax data contributes to making a well-informed decision making, which ultimately impacts your bottom line. In the course of next 30 minutes, you would see and hear from the subject matter expertise of corporate tax, transfer pricing, and VAT as to how these three laws independently and cumulatively can lend their color, their flavor, and enhance what we call as a well-run tax governance framework. With that, I'd like to hand over first to Isabel to take us through as to what are the constituents and building blocks of a robust corporate tax framework.
Okay, thank you, Anush. So to your point on the relevance of a strong governance framework, there are some key documents that, as best practice, organizations should have. I will mention a couple of them. We can start with tax strategy document, which outlines the overall approach to tax management, including tax objectives, risk appetite, and commitment to compliance, followed by a tax policy that will provide rules and guidelines for managing tax matters and ensuring consistency in tax decision making. We also would need a transfer pricing policy, which is a must to have, but this will be covered by my colleague Anna in the following section. We can also have a tax risk management framework to include the company's approach to identifying and assessing and mitigating tax risks, along with a tax compliance calendar to keep track of all tax-related obligations. A roles and responsibilities matrix that would clearly define who within the organization is responsible for various tasks-related matters and ensures accountability. A tax control framework will define controls in place to ensure compliance and mitigate risks. And it is also important to have engagement protocols with tax authorities that would define how we will interact with tax authorities, ensuring transparency and consistency. A tax reporting and disclosure policy will ensure accurate reporting of tax-related information in the financial statements and other public disclosures. For example, deferred tax, current tax, effective tax rate, and tax disputes to be covered. A training and awareness program will ensure that employees are well informed and are capable of managing risks. And lastly, a tax audit and review procedures would be important for conducting internal and external tax audit reviews. If we move, yeah, thank you. Now moving into corporate tax, the UAE corporate tax law establishes several key compliance obligations that need to be integrated into the tax governance framework. It provides for corporate tax registration within prescribed timelines, and failure to do so would result in penalties of 10,000 dirhams. The corporate tax of the tax within 9 months after the end of the tax period, and failure to comply with it will result as well in penalties in the range of 500 to 1,000 dirhams on a monthly basis, depending on the case. The corporate tax law also requires to maintain accurate records and documentation for at least 7 years, and failure to do so would result in penalties that could range from 10,000 dirhams to 20,000. Lastly, taxpayers will also need to undertake tax audits from the Federal Tax Authority. So if we go. Now, what are some of the critical points to consider when adapting our tax governance framework from corporate tax perspective? So first of all, we would need to understand the scope and applicability of the corporate tax law, as this is crucial to tax governance because it defines which entities are subject to tax and how it will apply. This might include residents, non-residents, place of effective management, permanent establishments, exemptions, and special regimes such as qualifying free zone persons or tax groups. When it comes to tax strategy, companies would need to make sure that the board member is involved for achieving an effective tax position. So the board member will need to understand the impact of corporate tax law in profitability and in cash flows so they can make strategic decisions for the organization. In terms of risk management and controls, the UAE corporate tax law requires companies to navigate new rules for calculating taxable income and allowable deductions. Processes for calculating such computations should be in place, and there should be included guidance on various tax treatments. We also need to ensure that financial statements are ready before the filing deadline, and interaction with other regulations such as economic substance requirements and VAT are important to be integrated within the corporate tax framework as well. When it comes to tax compliance and changes in law, companies would need to understand the requirements that would need to be made at a system level. They might need to update their systems and assess the HR requirements to manage deadlines and workload to mitigate risks and errors. They will also need to ensure that processes for dealing with tax audits are in place, and the tax governance framework should be flexible to adapt to the evolving city landscape and incorporate new guidelines, laws such as Pillar 2, which was mentioned earlier. Finally, in terms of corporate structuring and tax planning, the common challenges for multinational groups are like tax residency or other tax matters can also impact how tax liabilities are managed and calculated. Therefore, in the tax governance framework, it's important to address intra-group structures and make sure that they are compliant with the corporate tax law, ensure the efficiency of cross-border transactions to make sure that double tax treaties are properly applied, withholding taxes and foreign tax credits are properly addressed. And lastly, because there are multinational groups with presence overseas, tax compliance abroad is also important to integrate into our tax governance framework to follow local regulations and identify the gaps that this could bring against corporate tax. So I'll pause here, and now I can pass it on to Anna, my colleague, to cover transfer pricing.
Thank you, Isabel. So indeed, transfer pricing has become increasingly important due to globalization and cross-border activities between related parties nowadays. So the reason is that the transactions between group entities can be used to artificially shift profits from the entities in high tax jurisdictions to low tax jurisdictions, and from high tax entities, let's say mainland company that is taxed at 9% rate, to low on non-tax entity, like free zone entities which qualified for 0% rate. That resulted in overall lower tax burden for the group. Therefore, TP regulation has become introduced in many countries to eliminate such base erosion and profit shifting to ensure fair allocation of the profits. So in December 2022, TP rules were released in the UAE as well. And in October 2023, FTA issued TP guide, which provides a practical guidance to the taxpayers on TP regulation in the UAE. And it is broadly aligned actually with OECD TP guidelines. Also, it's important to notice that one of the key conditions for qualifying free zone person is to comply with transfer pricing in order to avail the benefits of 0% corporate tax rate. So therefore, it is very important for taxpayers to evaluate the potential transfer pricing impact and establish a robust transfer pricing policy, as well as maintain comprehensive TP documentation in order to mitigate all TP-related risks. So further, let's discuss who is subject to transfer pricing, what are the requirements, and why and how it is important to get prepared in advance. So TP rules in the UAE, they apply not only to multinational group entities, but also to any transactions with related parties or connected persons in domestic groups within the UAE. All the transactions have to meet the arm's length principle. What does it mean? It means that the prices of the transactions between related parties should be at a fair market value, or as if the transaction had occurred between independent parties in the similar circumstances. The payments to connected persons, such as salaries or other benefits provided to the owners, directors, and other key decision makers, are also subject to transfer pricing rules in the UAE. And in case these benefits paid to connected persons are not at arm's length, so the taxpayers cannot deduct such expenses for corporate tax purposes. So when control transactions have been identified, a proper TP policy should be established. And first of all, accurate functional and comparability analysis should be conducted. Based on the functional analysis, a corresponding economic analysis can be performed, including selection of appropriate TP methodology, conducting a respective benchmarking study in order to substantiate the arm's length nature of the respective transactions. So in any case, the adequate supporting documentation is required to explain the reason for selecting respective TP methodology, and this methodology should be mandatory documented in TP policy and provided to FTA based on their request. So today we won't go into the details of the economic analysis. So if you would like and you're interested to learn more about our transfer pricing concepts in the UAE, you can follow our series of publications, Decoding Transfer Pricing with GT UAE, and we will provide our QR code which you can scan at the end of our webinar. And also don't forget to subscribe to our LinkedIn page and follow us and stay tuned with us. And meanwhile, we are moving to the next slide and we will talk about transfer pricing compliance. So taxable persons meeting certain materiality thresholds are required to maintain a master file, local file, TP disclosure form, and CBCR, which is country-by-country reporting. TP disclosure form requires to disclose a related party transactions, values, applicable TP methodology, market value, and adjustments, if any. So it should be submitted also within 9 months after the year end. And let's say if you follow the calendar year, it means that your deadline will be September 2025. Local file includes such information as details of the local file and its counterparty, market overview, functional economic analysis, and financial information with regards to particular control transaction. Preparation of the local file is mandatory in either of two cases. The first one, if the taxable person revenue in the relevant tax period exceeds 200 million dirhams, or if the taxable person is a part of M&E group with a consolidated group revenue over 3.15 billion dirhams. A local file has to be submitted to FTA within 30 days upon their request. However, it is important to highlight that since the summary of the analysis performed in the local file needs to be disclosed in your TP disclosure form, local file should be prepared well in advance. Master file can be considered like a blueprint of the M&E group, and financial thresholds for the deadlines for submitting master file are actually the same as for the local file. CBCR is the highly used actually by the tax authorities in different jurisdictions to assess high-level transfer pricing and BEPS risks, because it maintains aggregate data on the global allocation of income, profits, taxes paid, economic activity, among other tax jurisdictions as well, in which the entities of the group are operating. And so meanwhile, we are moving to the next slide to find out about a couple of other interesting transfer pricing concepts. And first of all, it is substance over form approach. As per the UAE legislation, all the transactions should be evaluated based on the actual terms, even though the contract terms could differ or there is no formal agreement in place at all. So incorrect comparability analysis may lead to a wrong economic analysis and hence can be challenged by tax authorities. Whilst there is no obligation to prepare written contracts from TP perspective, it is highly recommended to conclude a written contracts for at least for material or some complex transactions in order to ensure these contracts are aligned with the actual circumstances, because such contracts will serve you as supporting documents during TP audits and will form the first line of defense. Another concept is commercial rationale, which means that all control transactions must have a commercial purpose and respective documentation in order to substantiate the economic rationale. If the main purpose of the transaction is to obtain tax advantage, the FTA may challenge the outcome of such transaction. FTA is entitled actually to adjust or disregard such transactions that are carried out without any valid commercial reason or replace it with alternative transaction. So again, a proper substantiation and documentation is required. When we are talking about transfer pricing adjustments, they can be made either by the taxpayers, so-called self-adjustments before submitting their tax returns, or by FTA during the tax audits. In order to eliminate any kind of transfer pricing adjustments, you may consider concluding advanced pricing agreement, which is APA. This agreement is between the taxpayer and the tax authority, and it determines in advance all TP methodology for certain transactions and for a certain period of time. So this instrument helps the business actually to mitigate the risk of transfer pricing adjustments and potential disputes with the tax authorities. And we highly recommend considering this APA procedure as soon as the procedure will be out. And as the burden of proof falls on the taxpayer, which is on you, so on the next slide, we prepared actually several practical steps that the companies may follow to ensure the proper compliance with the new TP regulation. So actually the first step will be, as we discussed, to identify controlled transactions with your related parties and connected persons. Step number 2 will be to ensure that you have a proper transfer pricing documentation in place to support your arm's length principle of the controlled transactions. And step number 3, to make appropriate adjustments based on the previous analysis conducted, or apply for APA or private clarification in case you have some complex matters or transactions. And last but not least, step number 4 is to adhere the compliance with the UAE transfer pricing regulation, which means to prepare TP policy, maintain TP documentation, which is local file, master file, and other reporting, and to ensure appropriate reporting in your financial statements. So therefore, if you follow all these best practices and get prepared in advance, you can avoid all future challenges and potential transfer pricing risks. So I appreciate your time, and I pass it over to Imran to further discuss VAT governance.
Thank you, Anna, and good morning to all our guests. So, I mean, firstly, it's hard to believe VAT is almost 7 years old. I remember, yesterday we were talking about VAT implementation, and of course the challenges that my colleagues in TP and CT are now sort of going through. What I want to do quickly on this slide is kind of talk a little bit about the evolution of VAT in the UAE, kind of along some key dimensions, what we've seen over the past 7 years, and how this might serve as a bit of a guide around what we might see for CT and TP implementation and the evolution of those taxes, and also things to be aware of when it comes to governance frameworks. So very quickly, taxpayer guide, public and private clarifications. Of course, we had a lot of taxpayer guides issued, of course, at the to coincide with the implementation of VAT, and they haven't been changed that regularly, to be fair. There's been a few updates to some of the key guides. Real estate is a notable one. However, we are still missing some guides in some key industries, and again, the one that springs to mind is international transportation. Public private clarifications, been quite a lot of public clarifications to clarify the various interpretations and applications of the law. And of course, I'm sure we'll see much of that to come along with CT and TP as well. And of course, the private clarification route remains probably the only way in which you can get some concrete guidance from the FTA on various transactions. Interestingly, on private clarifications, obviously there was a change to the way in which those are applied for. Taxpayer now has to pay a fee to actually get that private clarification looked at and commented on. But interestingly, we've seen sort of similar facts being submitted, but getting two different answers from the FTA. So again, very much caution around private clarifications and understanding the facts that they apply only obviously to the taxpayer. Changes in legislation. I mean, I was going to say it's been fairly stable over the past few years until last week. I think probably notably for VAT, we had some minor changes to the tax procedures law over the past couple of years. There was a change to the penalty regime also. And of course, last week they had probably the most significant change since 2018 in relation to the regulations, which I'll come on to shortly. Probably the other interesting thing to talk about is FTA practice and interpretation. Obviously, we've got the guidance. We've got the public clarifications, but in some areas, what we've also noticed as the time has progressed, we've seen changes in the way the FTA has interpreted what's in the law and what's in the regs and what they're actually doing in practice. So it may not be sort of stated in black and white, but the industry practice or the FTA practice has taken a particular route. So again, it's important to sort of understand what that is and make sure that we are sort of complying with that. FTA audits, obviously, quite a key aspect to all of this. We did see them in the early days being kind of fairly broad. Over time, I think they've become more focused, more standardized, particularly in VAT. We had the passing of the statute of limitation of the 5 years. We did see the FTA put out a lot of audit notifications. And as we've seen, the audit is, I say, the key sort of tool that the FTA uses to ensure compliance. And that is, as I say, I guess the sort of the thing that most taxpayers want to avoid. Penalty regime, again, has been very punitive historically, remains fairly punitive. We did have a little bit of an easement in terms of the penalty regime for VAT. Again, unlike European countries where you have some mitigation factors around taxpayer behaviours and sort of errors, etc., or the other sort of excuses for errors, we have less of that here in this region. So again, penalty is again the sort of the stick that's used by the FTA in a fairly black and white manner. Documentation requirements. Documentation was talked about by the previous speakers in terms of what that looks like and what those requirements are. Again, from a VAT point of view, what we've seen is that the documentation requirements for compliance in order to validate certain treatments has been very prescriptive and remains so. So again, that's something that is not much leeway or manoeuvrability around. Again, compliance is key, probably more so from a VAT point of view, given the frequency of returns. And again, each time a return is submitted, that is an opportunity for the FTA, obviously, to review what we're doing and potentially challenge some of those treatments. We did see, obviously, the extension of the first filing deadline for CT pushed out to the end of this year. So again, buying a little bit more time from a CT compliance point of view. All of the people, obviously, who have been working since the VAT implementation will have been familiar with a lot of this stuff and will be thinking about that as they head into CT and TP implementation and building that into a governance framework. We just jump to the next slide, please. So what I wanted to talk about on this slide is just tying it back to some of the governance building blocks that were mentioned by Anuj at the outset, and again, how VAT can feature in some of those. And again, most of the audience will already have started to establish some of these practices, but I just want to get a little bit of flavour of some of the key building blocks around VAT. And of course, the frequency of returns can obviously quickly compound errors and risks if they're not identified. So it's key that VAT risks are managed appropriately. And as I mentioned, the penalty regime remains largely black and white. So again, not much room for negotiation there. So again, need to make sure that we're managing our risks. Tax strategy, obviously, has been mentioned a few times. From a VAT point of view, it's super important, obviously, that VAT is proactively managed. It's not an afterthought after a transaction has happened, after a contract has been entered into, or where some new business has been started. Very critical, obviously to get VAT and the tax team around those discussions to understand proactively what that means. VAT awareness obviously also needs to be embedded across the entire enterprise, but most notably with the sales teams and procurement, those responsible for new business, new negotiations, etc., where I may not have a full understanding of VAT. And of course, the risks need to be sort of proportionate to the sort of wider business risk appetite of the enterprise. Tax automation training, obviously a lot of discussion around this, particularly in the sort of the backdrop of e-invoicing, which will be coming down the track by 2026. And what does that mean? So by now, I think a lot of taxpayers have probably led to some level of automation of their VAT compliance. Maybe not fully automated, but again, sort of hopefully a more smoother process. But again, that is a very good way to manage the VAT risks, is to obviously automate as much as possible from a compliance point of view, from a tax code determination point of view, if that's possible. I know there's some sophisticated software to help to do that, but in the absence of that, some decision trees with the AP and AR teams can actually work very well also. And again, a small point there on outsourcing compliance and other tasks of that nature, again, to help mitigate risk and get some sort of SLAs in place with certain service providers. Internal controls obviously goes without saying, but in the backdrop of VAT, obviously looking at the usual concept of maker checker when it comes to compliance. Obviously, when you're entering into a new transaction and a position is being taken on a certain VAT treatment, looking at the value and frequency of these types of transactions, how are they documented, how are they getting signed off? Very, very key and critical controls around that. And again, also, how does the internal audit function in some of the larger organizations look after the VAT and wider tax risks, and what are they looking for, and how often and frequently should they be policing the compliance of tax? Compliance with legislation obviously goes without saying that it's 100% compliance with legislation. The point I'm making here is that in many sort of jurisdictions, we have the concept of sort of spirit of the law versus letter of the law. I think the general rule in the UAE is that the letter of the law is to be followed. What does that mean in terms of revisiting some of the implementation VAT treatments that were in place? Obviously, at that time, we didn't have all of the information that we have to date. We weren't familiar with the FTA practices. So again, that's a good practice to go back and look at some of this stuff. So, for example, compensation type payments, would have been treated probably as wholly out of scope in 2018. We've seen that sort of particular treatment has evolved over a period of time. So that needs to be revisited to make sure that sort of any errors are not necessarily compounded. Documentation, record keeping, again, from a VAT point of view, and of course, other taxes, very highly prescriptive, as I've mentioned before. You've got the FTA audit file format, which is required, obviously, to be maintained by taxpayers and obviously then shared with the tax authority around tax audits. You have a very limited time frame in which to share that information, so you need to make sure that you have that and your systems are capable of producing those reports. Obviously, invoice formats, retention periods are obviously very prescriptive as well. And then there's a point there about documenting VAT positions. So anything that you do take, where there's potential element of risk, how you've reached that decision, how you're documenting that from an internal control point of view, again, will not only hopefully act as some level of defense, but also will sort of add to the robust sort of feature of a tax governance framework. Okay, next slide, please. All right. So I think by now, probably everybody is familiar with the changes which were announced last week to the regulations. I say that's via Cabinet Decision 100 of 2024. So as I mentioned, this is probably the largest overhaul of the regs since 2018. So fairly big deal, to be fair. Some 30 plus amendments have been made to take effect from the 15th of November 24. And just by standing back, the way I'd sort of categorize the flavor of these changes have been, either they're sort of administrative, there's been some level of clarification, or in some cases there has been some newly introduced changes which will have some far-reaching impact across either very specific business sectors or indeed more widely ranging. So I'm just going to talk through the main sort of 9 or 10 of these in the next few minutes. I think the first thing, it's a welcome introduction to see the concept of digital assets introduced into the legislation. Obviously, over the past period of time, we've seen an explosion of cryptocurrency platforms in the UAE. UAE obviously pushing itself as a sort of crypto-friendly environment. Seen a lot of trading houses set up specifically for crypto or hybrids with crypto and traditional currency transactions. So very welcome introduction of the definition of what is a crypto asset, obviously now brought into the definition of financial services. So the broad treatment is that these will be VAT exempt, obviously looking at the types of transactions that will be subject to the exemption. Interestingly, for this particular amendment, it will have retrospective effect to 1 Jan 2018. I think from my interaction with some of the players in the market, most of them, even in the absence of any sort of particular guidance, have been treating transactions in a similar way as you would do to any other financial services transactions. So hopefully we've been landed in the right place from an exemption point of view. But of course, any businesses who are operating in this space will need to review the transactions and understand what treatment has been applied. And of course, what's that mean for input tax recovery historically? Do they need to make any adjustments and corrections by way of voluntary disclosure? And how would they go about doing that? What's that mean for penalties specifically, if there are any? Fairly big change for investment fund managers. Investment fund management now is obviously the definition has been introduced again within the scope of financial services. So what is it? Again, managing a fund, etc. A licensed fund, a fund licensed by the competent authority. Interestingly here, though, the VAT exemption applies to all activities of the investment fund manager. I think it's a significant change because most fund managers will typically have been charging a fixed fee or a percentage-based fee on various transactions, and will likely have been treating this as standard rated. So could be some fairly wide-ranging consequences for them in terms of input tax recovery going forward. What does it mean for registration? Obviously, if they're now wholly or partially exempt, are they still eligible for VAT registration? If they are, and they're part of a VAT group, does now the exemption obviously impact the recovery of the VAT group? So quite a significant change. Input tax recovery. So this is, again, will have quite wide-reaching change for businesses that are partially exempt, real estate, financial services, etc. So no change to the underlying treatment of standard method and special method in terms of application, but there has been an amendment which will allow taxpayers using the standard method to potentially use an agreed recovery percentage based on the previous year on on quarters, on periods in the current year, and that again, that will be agreed with the FTA. So that's quite a welcome change, a welcome compliance relief. But of course, it needs to be looked at in terms of how exactly that will work in practice. What are the pros and cons of doing that? It obviously won't dispense with the need to do annual adjustments and actual use wash-up calculations. The other slight tweak there is that the 250,000 dirham threshold for the assessing an actual use adjustment, where you've got a tax year of less than 12 months, that 250,000 limit will need to be prorated, so may now have an impact for people going forward. Next slide, please. Export documentation. I think this will be a welcome relief from a documentation point of view. Again, given what I was saying a bit earlier about documentation being very prescriptive, thankfully the FTA have applied a bit of common sense approach here. Export documentation typically, in order to zero rate that, businesses have been required to hold the exit certificate, which has been a bit of a challenge to get hold of from the various customs stations in the UAE. Lots of taxpayers are able to get hold of the commercial evidence, bills of lading, shipping documentation, etc. So this change now allows that alternative evidence to be used as evidence to demonstrate the zero rating. So I think that's quite a welcome change. Zero rating. Again, zero rating export of services to businesses outside of the UAE can be zero rated subject to certain conditions, which is no change there per se. The only main change has been there's been a inclusion of, or at least a specific exclusion of those services which have which are subject to the special place of supply rules, catering services, real estate related services, sporting, cultural, i.e. any of those which are either used, consumed or enjoyed in the UAE. So I think that was a fairly common sense approach anyway across most businesses, but that's just been clarified. So important zero rating changes for international transport, or at least some clarifications. And again, I think I'd really welcome a guide in this area rather than just a few snippets around zero rating. But again, just talking about services in relation to international transport, they should be made to the supplier of the transport in order to get the zero rating, and a few points there around zero rating for the repair and maintenance of international transport, means of transport, and again that those must be made on board the transport. So again, small snippets in that space, but as I say, I would welcome a guide. Government entities, again, this is a bit of welcome relief for them, especially when it comes to the transfer of real estate between government entities. That's no longer a supply for that purposes. And the second point there is where there's been a grant or a right to use or exploit this real estate, that's no longer a supply from 1 Jan 23. And that's fairly big development, given that a lot of the large real estate entities, land bank owners, are, of course, government entities. This will obviously dispense with all the VAT considerations for those. And a change to the deemed supply rules, both for government entities and charities. So supplies between these entities where they're less than 250k fall outside of the deemed supply rules. So again, quite a welcome relief. Next slide, please. Health insurance and input VAT. So I think this is going to have, very wide application, if not to all businesses operating in the UAE. So the change, obviously, is that VAT recovery will now be allowable not only for the employees' health insurance, but will be extended to the spouse and up to 3 children to 18 years of age. And again, that kind of brings us in line with the treatment in Abu Dhabi, where the requirement to provide health insurance was within the labour law, and the VAT treatment in Abu Dhabi was therefore different. So this should bring everybody on par and should be a welcome change, especially when it's a mandated, a very common benefit that's provided. I think the point to note here is, especially we've been working over the past few years to sort of make sure that the AP teams are aware not to recover VAT on the health insurance. So I think getting them back up to speed and training them to explain what the difference has been is very important. Secondly, is that you have the correct documentation, because in the past, for example, if you've not been getting a tax invoice from the supplier, it's not really been a problem per se, because VAT hasn't been recovered. So of course, going forward, that's something that will need to be looked at. Next key point is around tax invoicing. Slight changes in a couple of cases to the 14-day rule. And those are in relation to simplified invoices, so invoices less than 10k or B2C invoices. Here, the simplified invoice now needs to be issued on the date of supply. And the second change is in relation to summary tax invoices. I've not seen a lot in practice, but these are invoices to the same person, multiple supplies over the same tax period. You can now issue a tax invoice by the 14th day of the following month. So 2 changes there. Again, the point to note here is that tax invoicing documentation has been a key feature of all FTA audits. So again, this will be something that they will be policing going forward. Other notable amendments that I wanted to just touch on: composite supply. So we're looking at single supplies made of multiple elements. Clarified to say that the VAT treatment will be determined by the overall nature of the supply, where there's no main component. Now, that's an interesting point for clarification, but from a purely academic point of view, I'm still wrestling with the fact of, if we've got a single supply and there's not a main component, is it a single supply or is it now a composite? I beg your pardon, a multiple supply. But that's more of an academic discussion that I'm having. I was struggling to find an example of where that might fit. But if anybody does know, then please share that with me. Capital assets. The reason I mention this is because, again, I've not seen too much application of the capital asset scheme. And this could be a sort of segue into the FTA now looking at this in audits a bit more carefully. And the change here really is just to specify around self-developed capital assets. The first tax year for those will be the first year that they are in use, rather than when they're, for example, constructed or whether they are recognised as capital asset on the books. But I think the point there is capital assets, if you're in the real estate world, or if you've got that sort of if you've got any capital assets on your books, just revisit that from that point of view to make sure that you are complying. Residential buildings, slight change, or should I say a couple of inclusions in the exclusions from what is a residential building. Hotel apartments and serviced apartments are now specifically excluded from being recognised as residential apartments. And I think most players in this space will already have appreciated that hotel apartments and serviced apartments will typically be standard rated given the level of service that's attached to those. Been a few issues around hotel apartments that somebody has purchased. There's no service element, but at the DLD level, the classification is down as a hotel apartment or a serviced apartment, and that's caused issues with the FTA and what the treatment should potentially be. Voluntary registration, again, slight clarification here is that you may only apply for registration voluntarily if you are indeed carrying on a taxable business. If you are carrying on a business, you're already carrying on a business and you have the intention to make taxable supplies in future. So again, small clarification. What I'd like to see us get to is a situation where traders who are intending to make taxable supplies, but are not doing so today, can actually recover VAT on that basis and not wait until they make a first supply. And again, I'd like to see that aligned with treatment in the EU, for example. But we're probably a little way away from that now. Probably the last thing to say is that, again, there's been a significant cleanup of language, definitions, again, makes the legislation easier to read, a little bit more easy and connected with the VAT law. There's quite a lot there to digest, again, through the regs. If you will have seen, hopefully, some of the main changes in our news alert last week. And of course, it goes without saying that if there's any specifics that you need sort of to consider further, then please reach out to the team. And with that, I'll hand back to Anuj to help us wrap up.
Thanks, Imran. Clearly, a whole lot of changes coming after 7 years of a stable VAT law, but welcome ones. I think if we move on to the next slide, and if we keenly notice, I think if a 7-year-old law, which seems to be pretty well established, has to undergo these robust changes, one can only expect the level of changes one would perceive in the corporate tax law, which is just about making a soft landing. There are a lot of things to still fill the gaps on. A transfer pricing law, which is otherwise based on OECD, but has a lot many local nuances. We also have to continue to deal with economic substance regulations. And while we deal with all of this, the business continues as usual. The finance of the tax function would be marred with various different threshold requirements, whether it is for master file, local file compliances, as Anna tried to mention in her narrative, or whether it is a small business relief. The thresholds for when do you require an audit for corporate tax purposes differs to when a particular business relief exemption can be taken, for example. And all these nuances will continue to have an international footprint where you are a multinational group impacted by the global minimum tax or impacted by a particular tax treaty provision, which under the MLI regime has significantly changed in interpretation. Now, as one maneuvers through all these uncertainties and tries to settle more and more tax matters for the benefit of the overall group and in order to determine certainty on your tax positions and tax rates, I think the role and responsibility of a tax professional in-house or a tax function was never more relevant and more significant. And I think the key takeaway for us is whether it's to deal with various elements of these laws, one would have to emphasize on the similarities, but also appreciate the dissimilarities. Even when the corporate tax law was released, the reliance on IFRS was predominant. And I think many of us have already experienced how that is of significant consequence. And it's easier said than done that the corporate tax law computations can follow the IFRS basis of accounting. I think with that, in the interest of time, we would like to hand it over back to Steve for an opening of the Q&A session.
Thank you very much, Anuj. So this code you can see here takes you to our website as well. So if you need any further information, then please do contact us on there. We also do publish a monthly news alert across the GCC on taxes. We also publish a 2 fortnightly update for transfer pricing. And there's various tax and VAT alerts we've published recently as well, which you're welcome to read. So in terms of questions, we have quite a few, so I'll try and go through selected ones. So the first one, Isabel, is to yourself. This is about transferring losses. So that's now published for everybody to see. So Isabel, if you're able to please just give a reply to that, that would be helpful, about carried forward losses.
Sure, Steve. So I understand the question is with regards to the application of tax losses and the changing in ownership. So just as a general note, specific rules apply for juridical persons that have tax losses carried forward and have had a change of ownership in the tax period. A tax loss can be carried forward by a taxable person, provided that owners of the taxable person continuously hold at least 50% ownership from the start of the period in which the loss is incurred until the end of the tax period in which the tax loss is used or offset against taxable income. If there is a change in ownership of more than 50%, tax losses can still be carried forward, provided that the same or similar business is carried on following the change in ownership. So I hope this clarifies that specific question. And over to you again, Steve.
Thank you, Isabel. Okay, so in terms of VAT, we have quite a lot of questions, as we'd probably expect with all the announcements. So Imran, one for yourself, and this is about management fees. So the question is around, obviously you mentioned there about backdating and retrospectively. So this is around recoverability on management fees. If you're able to answer that, please.
Yeah, thanks, Steve. Yeah, so I think interestingly, on management fees for investment fund managers, I think this was going to be a prospective change. So the historical application, to be honest, it's probably fair to say that depending on what you've done to date, probably can still be valid, given it's not a retrospective change. But obviously going forward, it's going to be quite an impact on VAT recovery, given that the whole service and the whole management of funds, etc., reviewing their portfolios, reviewing performance, is all going to be exempt. So I think there's going to be quite a big ripple from this particular change. And I'd be interested to see if there's any specific clarification from the FTA around how historical periods have been treated. But as of the moment, I would suggest that though VAT recovery thus far is probably okay until further notice.
Okay, and Imran, while I've still got you, another question about selling of shares and whether they're subject to VAT on a gross basis as well. So I've just published that so everybody can see that question. So if you're able to answer that, please.
Yeah, so no specific change to the sale of shares. Same treatment should apply. Obviously, VAT exempt as the way they have always been. So no major change there per se.
Okay, thank you. And one question for Anna on transfer pricing, and this is around group companies. So if they don't meet the threshold to maintain local files, is there still requirement to comply with transfer pricing rules? If Anna, you could answer that, please.
Okay, thank you so much for your question. So indeed, if your group does not meet either of those financial conditions that we mentioned before, either the revenue on entity level basis 200 million dirhams or group revenue more than 3.15 billion dirhams, then indeed you're not required to maintain either local file or master file. However, you still need to maintain reasonable records in order to substantiate your arm's length principles within the controlled transactions with your related parties and or connected persons. So mainly it could be transfer pricing policy, as we mentioned before, with the respective functional analysis, comparability analysis, the benchmarking studies, agreements, invoices, and other relative supporting documentation, depending, of course, of the nature of your transactions. And we all should remember again that FTA is eligible to request all this information and it should be provided within 30 days following their request.
Thank you very much, Anna. Okay, so we're almost at midday now, so we'll wrap it up. But like I say, thank you very much for attending and spending an hour with GT today. And we will be holding other events in-person events as well, rather than just webinars. So thank you again for all the questions. If you do have any more questions, please do post them, send it to us, and we promise to reply to every single one. And like I say, unfortunately, we've run out of time, so we can't answer as many as we've had in. We've had over 200 people on the call as well, so that's brilliant to see. And I hope today you've taken away something and learned something from what we're trying to say. So compliance is really important, to comply with the regulations, obviously. And obviously, we're here to help Grant Thornton as well. So thank you again, and have a great week ahead. Thank you.
Thank you.
Thank you.
Thank you.